My music's got you pumped. Well, that's exactly what it's supposed to do. Welcome to the official Trade Talk channel where I show you how I analyze price for the most consistent and higher probable entries to help you guys become better traders. Today we're going to be taking a look at all the markets, and we're going to be watching FOMC when the meeting or the minutes come out at 2 o'clock, and then naturally there is a press conference at 2:30. So what happened last time was the news came out and it was actually bullish for risk on assets. So we did get a bullish pop. Same thing happened yesterday. We had bullish price action trading up into the CPI numbers. The CPI numbers were still very bullish for risk, but that move ended up getting faded. However, the only thing that occurred from the fade was the gap fillage in the village. Basically, you just filled the gap on the SPY. You can see that in the bottom right hand corner of your screen. Here is the previous day's candle. Yesterday, we opened up here at 9:30. That's an hour after the news. And the only thing you did was trade it all the way down and you filled the gap. So you can see currently today you are up above that. So a lot of speculation on the street going on right now. A lot of people are swinging very bearish. A lot of people are swinging very bullish. But if the Fed does what he did last time, if Mr. Jerome Powell comes out and tries to stop the markets from going up because he's afraid that that somehow would hurt inflation, then he'll talk them down again. And if he does that, you could see a nasty wild upswing for the actual minutes when they drop the actual rate hike itself, if it's 50 basis points or lower. 50 basis points or lower, we do expect a bullish pop. Anything higher than that, the markets will absolutely more than likely take a hit to the downside. But then we have to be very careful because, like I said, as soon as the news starts, as soon as the news conference or press conference starts, he could get very hawkish just in the speech itself. And we have seen the original minutes get faded. So a lot of stuff going on today. We're going to see if we can't find an entry. Naturally, we are day traders. We do look for day trading entries. Currently on Bitcoin and on Euro USD and on S&P 500, you are trading above the high of day. That means you have just made a fresh, brand new high of day. So that's not typical. That is not typical price action that we see coming into these big data-driven events. We typically see the markets trade sideways. We have not seen that the last 2 days. So I expect very volatile price conditions. The one thing that we do have that is different than yesterday is the VIX. Yesterday, the VIX, which is something that usually trades inversely to the S&P 500, was actually pumping at the same time that the SPX was pumping. Now, when the CPI numbers dropped, we had a nasty spike lower, when the market opened. So you can see that you gapped well up here on the open yesterday and then just faded. Now, you have faded down to daily support. These are typically areas where we do look for entries if we do think that an asset is going to continue up. The fact that we're trading at the high of day, not necessarily speaking a very good message to me. But hey, I've been wrong before. I was wrong yesterday. I might be wrong today. Trading very high risk news events such as non-farm payrolls, FOMC, CPI, PPI, you name it, the list goes on, is very risky. And what I need from you guys is to make sure that if I do indeed give you a set up, meaning entry, stop loss, and take profit, that you mitigate your financial losses. Do not bet 100x that I will be right, or you will lose all of your money plus a little more. We mitigate our risk. We do this stuff the proper way. We are not gamblers, or at least we don't like to call ourselves gamblers. How's that? All right. Let me get one sparked up here and we'll get ready to rock and roll. Alrighty then, let's see here. So we did have a spike of volume coming in today, right here this morning at about 11, 12, 1 o'clock. You did see a pretty good sized spike in volume. I would assume that this was probably people taking short positions, and those positions have since been stopped out. So typically in a situation like this, we would not be looking for a liquidation break trade. What that simply means is we would not be looking for the asset to run above the day's high and then flip bearish. However, it can absolutely happen. So I will leave that up to you in what decision you wish to make, right? If you want to be bullish, then wait for a support test. If you want to be bearish, then you're going to be looking to take a sell trade. With the newsprint coming up, then you might want to just wait until we get the actual press conference, because the first run, or the 30 minutes moving up into the press conference, that entire move could be faded. So you could see very extraordinary bullish price action going into the meeting, or vice versa, very extraordinary bearish price action going into the press conference. And then at the press conference, that price action reverse. We've seen it before, can happen again. It's very volatile, and we do expect a big move. The VIX is pricing in a pretty substantial move. Let me see if I can get this pulled up over here real quick. So we'll just bring this over here, and I will show you what I'm talking about here. We want to pull up the VIX right there, and you can see that you are pricing in a 120, or a $2.9 move. That's a pretty big move. So yeah, 120.56%. That is implied volatility for today. This is 6 days out, but the VIX does differently. They have their expirations on Wednesday instead of Fridays, like the S&P 500. So yesterday was the expiration. That's why you have 6 days left on this weekly contract. But you can clearly see at 120% implied volatility being priced into the market. So if you're doing this by trading options, by purchasing premium, you are buying premium that is very much jacked up and expensive. So there is, if you only go out 6 days or even 13 days on that premium, there is a very good chance that even though you are right on direction, you could still lose money, because the implied volatility, as you can see next week, is going to be substantially lower. So just that decrease from 120 down to 98 would be a loss of premium. So what we're probably going to do is we're probably just going to look for a position to take on Bitcoin instead of trying to trade options today or take new entries on options. We have 1 minute to the news, and you can see you're already starting to get that spike on Bitcoin. So let me get my account pulled up over here. So I'm going to watch the high of day. More than likely going to take potentially a short entry here, and we'll see how it plays out. So there it is, 2 o'clock. Let's see. We got to see if we get a spike. SP taking off to the downside, so I'm going to go ahead and hit it with a sell position right now. Oh no, what just happened? Oh no, don't do that, you bastard. It's going to make me log in, so I probably missed it. I was logged in, so I don't know what the hell what happened there. But basically, just if you're taking a short trade, you wanted to make sure that you get that entry in. Put your stop above the high of day, right? This is a pretty substantial drop on the S&P 500, which is typically what we're looking for, considering that it's been trading up all damn day. But I will never get logged into this broker in time. Let me go grab my laptop. All right, I got my laptop here. It should be logged into my laptop if indeed I have been logged out on the main PC. Let's see what it says. Let me get rid of this right off the bat. And let me get rid of this right off the bat. All right, don't worry about that. All right, so there goes the move. I have clearly missed the trade. But remember, we may still get a trading opportunity when the press conference starts. So you don't have to necessarily get in here. Let me get the low of day pulled up here on the SPX, because if we take that out, it might be a buying opportunity as well. You just made a fresh daily low. So you went from daily high to daily low. All right. Well, you're a piece of shit, Bitget. No, I'm just kidding. You're not. It's my fuck. It's my fault. My fault. My fault. But that would have been a beautiful trade, as you just almost made a fresh daily low on Bitcoin too. So from where I was looking for the entry to down there, that would have been one and done for us. But yeah, that was a big, big goofball error on my part. Lovely, lovely. So the VIX at daily support. Man, I'd hate to buy some options on the VIX right now, call options, but we'll see how this goes. Let's go see what they said. It looks like they were looking for 4.5%. That is a 50 basis point rate hike, and that's what they got. So the market was literally just pumping everybody's hopes and dreams up. And then when we get the actual number itself, which is in line with expectations, in line with forecasts, boom, there it is. So you can see last month we went up to the Fed's fund rate is up to 4%, going up 4.5%. That is a 50 basis point rate hike. So coming right in line of expectations. We don't have all the forecasts for the medium risk over here, news prints, but it would be nice to have that so we can see what actually is going on over there with all that. So it does look like we do have some changes over here. 4.6%. You're actually going to go up to 5.1%, 3.9%. This is all information coming from the dot plot. That is probably why you're seeing a sell-off right now. But all you've done was liquidated both sides of the marketplace today. You've smoked the highs, you've smoked the lows. And like I said, when he starts speaking again, now what is going on here? All right. It's reconnecting, so I'll give it its time to do what it wants to do here. Yeah, like I said, he could definitely come out, start speaking, and say that because we did get such a good number on inflation, there's a pretty good chance that we'll just leave it alone, or slow the rate at which we are hiking rates, and the market will take right back off to the upside. If he comes out with a heavy hawkish stance, like he's trying literally to make the market sell off, that's because that's what he wants to happen. What is going on with this thing? There. All right, I gotta log back in on Thinkorswim. Just give me a minute. Totally unprepared for this. I would rather see where we are coming into the press conference, really, anyways, because it could be faded. And we would like to get on the right side of the fade more than anything, because the fade itself could be the actual move that we see for the rest of December. Kind of was looking for this move, because on the euro, you can see that this thing has gotten pretty parabolic here. Let me pull this back over here where it's supposed to be. And then pull up this. And then get you guys back up over on this monitor here. Beautiful. Now we got all our monitors situated. Yeah. Good stuff. Yeah, we made a fresh low a day there. We did not make a fresh low of day on the S&P or on Bitcoin. You can see right there looks to be the low of day. That wick there. So there is just a little bit of room left down to the low of day. So if Bitcoin stays trading inside of the range that you currently have, this square is your current daily range. If price action stays trading inside of this, and then he starts to speak and we get a nice stab lower, I don't think you'll go all the way down and take out yesterday's low on just a stab lower, but who knows, right? Who knows? This thing is pushing lower, and wherever this thing goes, I expect this to go. So if, as long as the low of day stays intact, then a run below it could be a buying opportunity for the fade trade. But the liquidation break trade just kind of sort of happened, but we typically don't want to do them when you've been liquidating highs of day all day, right? Each 5-minute candle makes a fresh daily high. You've already liquidated it, essentially. But you can see there are a lot of drops coming here. Let's get us up to speed here to an old daily res. Let's just get that pulled up. And then naturally we have yesterday's close, which is vitally important. We don't need that. Yeah, I think this is good. So you can see how you drop down to the line that I just put on the chart right now within 2 seconds. That's how accurate this stuff is, guys. Use objective support and resistances, and you will see yesterday's close right there. And today, that's where the spike down went to. Yesterday's close, not this intraday stuff. Yesterday's close. Right down to it. Bing. That would have been a profit target region. Take profits upon the bounce there. I need you to stay pulled up, Mr. Laptop, because I need to be able to take entries. All right. Let's see the VIX spikeage. Not really a whole lot going on the VIX. I mean, that's not as big of a spike as I would have imagined, because you're still trading inside of yesterday's range on the VIX. So you didn't take out yesterday's low on the VIX, and you damn sure ain't even close to taking out yesterday's high. Yesterday's high on the VIX is what? 25.84. You're not even close to 25.84. You're trading at 22.90 right now on the VIX. So yeah, there was a spike, but not anything nearly as volatile as I expected. Oof, what did I just do? And we don't need that. Objective resistance is there. Old resistance. And we want objective support there. Good. Now we have those levels. Let's move over here onto the S&P 500. There's also something that I want to show you that is currently happening on the S&P 500. So while we got some time to kill, let's do this. I'm going to draw a trend line, everybody's favorite thing to draw. All right. So that was your current uptrend, right? You can see on last Wednesday, we got a nice big strong spike up above that. And then last week, we just sold right off, closing down below the 21 on a weekly closing basis. Yesterday, spiked well above this swing high. But by the end of the day, like I said, you faded right back down. So you kind of are struggling here on a trend line break. So this bearish action here, you did get that close. Even though this wick turns that weekly candle into a trap, if you will, you're still trading under supply, weekly supply, as well as this very almost parabolic trend line. So when trend lines get straight up like this, we do expect pullbacks and a breakage of them even, all right? This is going to be the close on Friday. That's the candle right there that closed below support. That candle's closure also made you close below weekly support and below the weekly 21 exponential moving average. You can see here we want to mark on this chart yesterday's low. I don't know if you'd get all the way down there, but like I said, if you do get down there and he's not very hawkish when he speaks, this entire move could be faded. We did set a bear trap, and then we took out the bear trap with yesterday's price action. So right now you have a very mixed signal on the charts, technically, only technically. Which is the only way this is the only way we do it. But technically, you get a lot of stuff going on. But here are the two trend lines that are relevant on the euro, here and here. And then if you go from this swing low up to this stuff up here, you can see just how parabolic the trend got the last few weeks, right? So it's only natural that when it starts to get like that parabolic, that we start looking for a pullback. And you are currently getting that as of right now. Looks very similar to what we see on the euro on the hourly. I mean on the this SPX on the hourly. This isn't quite as big, but it's still a pretty good size candle nonetheless. Let's get its relevant levels up. So yeah, you're probably not going to take out low of yesterday, because low of yesterday is all the way down there. That's a long way to go, but current low of day is definitely on the table. Yeah. All right. Good day, traders. Good day, Mr. Nick. How are you doing, my friend? What the hell is that? Look at Bitcoin. Yeah, I know. That really sucks because I was ready to just market into it, but I hit the sell button and the computer screen glitched and then refreshed itself and told me to log in. Which sucks because that was easy money. And I hate missing easy money. Hate it. But we may still be able to catch something here because, like I said, the low of day is still intact. Can you still explain how you were going to enter and execute the trade? Yeah, I was simply just going to take a market order because we got the news and the first thing that happened was the spike down. So what I would have been looking for is an entry on this 5-minute candle pushing back up into that resistance. I don't think it's resistance on a very high time frame. But you can see there are no candle body closures above that level. Yeah, there was really nothing of relevance up there on the higher time frame levels that we look at. So typically, like, this would have been a beautiful entry spot with a stop above the high of day. This wick is your high of day. Target would have been daily, old daily res, or yesterday's close right there. You also have the point of control right there, which means that's where in today's range and yesterday's range is where you traded the most volume. So more volume traded at yesterday's close today as well. More volume traded at yesterday's close. You see the volume nodes up here, small in comparison to these down here. Just the simple fact that it was trading up and trading up pretty vigorously today just had me thinking that there was likely going to be a little bit of a fade trade, because yesterday we went up 2 and faded that. The fact that we were right back to being bullish on the day in front of the news, that's typically not what you want to see. For an asset to remain bullish, we would rather see it kind of hanging out around the lows so we could get that spike down below the low of day or the low of yesterday, look for the buying opportunity for the actual expansion up, and can still occur because this is yesterday's low. We know that. So when the press conference occurs, if we get a spike down to that, you will more than likely get a wick under it. We would like to see the price trade back above it. And upon getting back above it, you could take a long entry and just throw your stop down at the low of day, the current low of day. That way, if it does just come down, go back up, roll back over, and come back down again, you get stopped out and you lose very little money. Typically, you don't want to be risking more than 1% or 2% on any given day trade. Quite simply because, you can miss several trades in a row before you actually nail the big one or the good one or the big good one. Whatever you want to say. I mean, good to hear your voice. Long time, old friend. Yeah, welcome back. So what now? We wait until the news, the actual press conference, and we will pull that up live once I find the link. And we'll listen to him live. So that way we can hear the tone of his voice, hear what he's saying. If he uses terms such as, we're still very concerned about inflation because inflation is inflation and we don't like inflation and inflation is no longer transitory, inflation, then we can, know not to be a buyer. But if he has the more dovish stance, then we can look for that wick below yesterday's low and potentially be a buyer. And like I said, as long as you're not risking a substantial amount of money, it's okay if you are wrong. If you're losing a lot of money, if you take a trade basically and you're afraid of losing it, or you are in the middle of losing and it hurts, then you're way too levered up. You've got way too much risk on the table. These trades should never hurt one another or nobody, right? You should never be hurt by being in a trade, and you should never be financially hurt by losing a trade. So we just got to wait till 2:30. We got 9 minutes. As I am trying to log into the brokerage, it's been having issues for me on the 2-factor verification lately. So I might switch that up. I might switch it from the way I have it now to a different way. It'll still be 2-factor auth, but I'll be using another program to generate the random numbers. Because this shit's annoying, man. And if, if what he's saying is very unclear, then we just don't do anything. We just don't do anything today. We can wait for a potential setup, the way that we usually trade. The best way to trade is never to take these liquidation break trades, because a lot of people will take these on normal days, and normal days you're not looking to do that because you're typically looking for continuation on a normal day. So typically you're not looking for a rejection at the high of day or a rejection at the low of day, because you're going to likely get continuation. So the way when we apply these trades is what's so very important. We apply them on high risk news events, because what we see with back testable data is that they generally will liquidate one side of the market and make a run down to the other side of the marketplace for that day's range. So what I mean by that is, if you're bearish all day and then the newsprint happens, you will see a run below the lows and then a run above the highs. That basically liquidates anybody that took a trade that day. If you took a trade before the news by throwing a wick under the low of day and throwing a wick above the high of day, you have thus eliminated most of all of their positions, essentially. And that's typically when we look to fade that move, right? Because bigger market participants need a ton of liquidity in order to enter positions. So the market just seems to do stuff that they want. So instead of being the one getting liquidated, we intend on feasting off of the dead bodies, essentially, like scavengers, if you will. We're vultures. We will come in and eat up the rest of the liquidity, and then, take the move lower. Like, you're only looking for whatever you get, that's what you look for. You just look for a spike in your direction. Once you get that spike like you got here, you take profits and you move your stops to break even. This way you get paid for taking the risk in the first place, but by leaving a small portion of the trade still open, if any continuation occurs, then you will make more money ultimately longer after, sitting in the trade for a longer duration. So by taking a very small stop loss or a very narrow entry to stop loss, it allows us to get extraordinarily, we get a lot of leverage, if you will. And then by exiting or closing out, say, 70% of the position size, that pays our P&L. So we came into the market with risk, but we left with profit. And now we still have a pretty sizable piece of a position on, because that position, albeit is only 30% of the original size, it is still very levered up. So even though it's a smaller trade, you still have the big portion of that leverage applied to it. So if you get 4 or 5 days of continuation, or weeks if you're lucky, right? Because occasionally you might nail a trade where you literally are in it for weeks and to months, then that leverage will apply as price just continuously moves lower. And the best example I can give to you is that of the USD JPY short I am currently in. That trade is just straight paying me right now. And I'm not touching it. See, when you're in a winning position and you have positioned yourself to where you cannot physically lose any of your P&L, you will always be risking something. Just by leaving that small portion of the trade on, you are absolutely risking your unrealized P&L. So anything that you have still on the trade, you're risking that. But it's not your money. By losing the entire amount of the unrealized P&L, your P&L still went up. So in a sense, you're just playing with the bank's money, not yours. And that's the whole goal of a strategy. Get in, get out with profits, but leave a little bit on to really pay you if you get in if you catch a trend move that lasts for months, weeks to months. And if there's anybody that's in here new and wants to see the open position on the USD/JPY trade, I will show you it. I have no problem showing open positions. Nan, not one. But it does become, you will get to a point sometimes, like in a sideways market, for instance, where that trade is really not benefiting you because there's like a cost, how do I say this? Like, there's a cost for being in a trade that is just going sideways, right? You're not able to deploy that capital elsewhere to an asset that is currently moving. So you're just sitting in a sideways market. So there's a time cost to that. Whereas you could just close that position and then use that capital somewhere else. But the problem with that is that means you have to go right back into the open market with new risk. And we never know if we're going to be right on a trade, especially when we're taking, delta positive positions, which is when we need the trade to go in one specific direction in order to make money, up or down. For instance, if you are straight all long delta, then you need price to go up, and vice versa. Long short or just straight short deltas mean you need price to go down to make money. When you're taking directional biased entries, you need a directional move to make money. That is where the risk inherently lies. On the S&P, on the SPX, I was looking at longer dated calls today, out like 74 days. And there's a substantial amount of call selling going on out like 76 days, and put selling on the same expiration, substantial amount of it. So people are like taking big positions from 29.50 and under. So basically what that means is if they're selling options at 29.50, they believe the market will not go lower than 29.50. Now 29.50 is definitely another move lower and another good 20% lower. But when you have elevated premiums based on the elevated VIX, then that's a gimme trade almost. And that means the premium will be more. And essentially all you're looking for is for the time decay. So you're looking to just make the money on the premium. You're selling the calls. You're being a market maker in a sense. You're selling the calls to premium buyers. And as long as the market doesn't go down to 29.50, they're going to get paid. And the premium today was nice. And the same, for instance, goes to the upside. If they're selling calls up above, $5,000, then they expect the market to stay within that parameter, $5,000 to $3,000. I mean, they're going out wide. And I'm talking multiple thousands upon thousands of positions. In fact, here's one right here. I'll show you. That's very, like a lot of people. You can see the premium on this baby, right? So like if you sold this 3,400 strike, this is 76 days out. 14,000 people have done it. You're looking to make $18 on every one you sell. That's $1,800 per contract. Well, not on the SPX. It works a little bit different than on the SPY, but yeah, $1,850 on every contract you own. But you just got to wait 2 months before you can actually collect all of the premium. So it's just, there's so many different strategies to trading options that, I'm just saying there's a lot of people that are expecting sideways markets. Not very many people that are taking a significant size like that, 14,000 positions at that 3,400 strike. 3,400 is just under the low. Right there's your low. There's 3,400. That's a put. So that means they're selling 3,400 strike puts because they don't believe the market's going to go back down there in 2 months. 3 months, 74 days. Thank you, baby. I got to get this, let me get this speech going. Somebody hit me in the Discord with the link. Because I don't ever have it. Ever. Maybe I can find it on an old. Let's see if this pulls it up. Yeah, I got a link, an old link here. I don't know if it's going to work. Video unavailable. But no, that doesn't work. Yeah, they won't be able to give it to me on YouTube. They got to send it to me. Thank you. Beautiful.
Balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market.
There's your low of day run. So if you were looking for longs, you would want to take a bullish entry now.
And prices. The median
Bitcoin
projection
still has
in the
a
S&P
little
for the
ways to go to
unemployment
make
rate rises
just
to
a fresh low of
4.6%
day.
at the end of next year.
Right,
Inflation
there's
remains
where we're
well
looking.
above our longer run goal of 2%.
There you
Over
go.
the 12 months
Fresh
ending
low
in
of day.
October, total PCE prices rose 6%,
So one
excluding the
would
volatile
buy
food and
that.
energy categories. Core PCE
You gotta
prices
give it a
rose
second.
5%.
This is volatile.
In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and
Now you're
food
back above
and has
there.
contributed to upward
Just for a
pressure on
second.
inflation. The median projection in the S&P for total PCE
So you
inflation
can
is
simply get long
5.6% this
till you
year
stop under the
and
low
falls
of day.
3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside.
7 would be your stop loss.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
The VIX gap.
But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
What a buy at daily support, man.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year,
target,
financial conditions have
of the
tightened
daily range,
significantly in response to our policy actions.
18 grand.
Financial conditions fluctuate in the short term in
number.
response to many factors.
Will it go up? I have
but
no clue.
It is important that over time they reflect
on the S&P 500, you liquidated 2 days worth of bullish price action.
Policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase.
Yeah, it could, Nick.
And we still have some ways to go.
But everything he said so far, we already know.
As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025.
That's all
still
of this
above
stuff
the median estimate of its longer run
right
value.
Here. So we already got all this.
Of course, these
info.
projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
So, all right, but
to conclude, we understand that our actions affect communities, families, and businesses across the country.
Does that mean you're going to keep doing 50 basis point hikes or
mission.
what? They are
we
going
at the Fed
to
will
keep
do everything we
hiking,
can to achieve our maximum employment and price stability goals.
But we knew they would have to continue to hike.
I will look forward to your questions.
How much are you going to continue to hike?
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraints that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen.
All right, so I'm not the sure. Like, you could interpret that as he's saying we don't control the risk markets, so in the near term we don't really care what they do. So basically his question was asking that, like, are you afraid if risk markets continue to push higher, is that going to affect your policy? And basically his answer is no, it's not. I mean, we can only control the supply side and blah, 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 blah. So
19 people
the
filled
market's
out
going to take it however the market takes
SEP
it,
this
right?
time,
It's either
and,
going to be bearish or bullish.
17 of those 19 wrote down
We'll see
a
how
peak
it takes
rate
it.
of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again,
Ongoing
for
hikes is fine.
our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP.
Yeah,
I don't know what
5.1
it will
is
depend
the
on future
market's
data.
not gonna
What
mind
we're writing
that.
down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course
Remember,
of this
if you
year,
get a spike up to 18K,
as we lifted off
when
and
you
got
stop
into
to break
the
even
course
that
of the
way.
year, and we saw
If it does end up rolling over, you're good.
how strong
you're
inflation
safe.
was now persistent, it was very important to
And
move
your
quickly. In
P&L
fact, the
goes
speed,
up.
the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. And that
the
applies to
market will
February as well.
probably take that.
So I think we'll make the February decision based on the
Okay.
incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And there the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually.
That's the midpoint of the daily range.
As rents expire and have to be renewed, they're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well,
not a lot of stuff happening.
I'll tell you what the
down
projection
here.
is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
As of right now, you've given back every bit of the spike
Thanks,
on the
Nick
VIX.
Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But, what you said is broadly right, which is having moved so
He hasn't
quickly
made
and
a
having now
judgment
so much
on what
restraint that's
size
still in
to
the
make.
pipeline,
So they're
we
gonna be
think that the
data-dependent
appropriate
moving
thing to do
forward.
now is to move to a
Means
slower pace.
They could
And,
slow down. They do
that
that.
will allow us to
Market
feel our
should
way.
Feel
and,
okay about that.
and get to that level, we think, and better balance the risks that we face. So that's
But
the
you have the
idea. It
news and
makes
then
a
the
lot of
market's
sense, it seems to me,
reaction to it.
particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see that.
I
You
would
see the
just
fact
let
that we made
myself
less
get
progress
stopped
than
out
expected on
at
inflation.
this point.
So that's why that
simply
goes up.
because the VIX
And
has
that's
given
why
back every
unemployment
bit of
goes
the
up, because
gains.
we're having to tighten
But
policy
just because
more.
these candles
And
looks
so
like
didn't
it
go up
wants
by
to
much
attack the
in
low,
the
we
media,
took
I
the
think,
entry
but
here
that's the
on
idea,
Bitcoin,
is
right?
slower progress on
On this
inflation,
push lower. So
tighter policy, probably
this
higher
point,
rates, probably held for longer.
you're not risking a whole lot of money
just to get
here.
to where the kind of restriction
If
that
you
you need to
are
get
risking
inflation
a whole
down
lot
to
of money,
2%.
if you are in pain, then yes, you
In order
close
to get
that
to that
position
number,
down.
how much of that could be caused by
But no,
layoffs
I will
versus
eat a
vacancies
stop.
trimming or
A
changes to
full
the
stop.
labor force population rate?
So it's
The VIX
very
says
hard to
give back
say.
everything.
You can look at history, right? And history would,
But this is
would
a
say
little bit
that
late.
in a situation
I'm
like
not
this,
sure if this
the
is actual.
declines
Let
in
me see.
unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that
Yeah,
there's
this
this
is a little
huge
bit late.
overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from
No,
many
it's
companies
not.
that they
We're
don't want to lay
at
people off.
2204
So
right
that they'll
now
keep people because it's been so
on
hard. I mean, I think
TD
it
Ameritrade,
feels
and I
like we
have
have a
actual live
structural
data on
labor
that.
shortage out there, where there are
This
4
is
million
live
fewer
data.
people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby
This
Smith with the
just
Financial
killing
Times.
premium.
How should we interpret
Killing
the
it.
higher core inflation
Even if
forecast for
you're right.
2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
You're currently trading under.
Well, I think that's why one of the
daily
reasons it went
support.
up was that core came in stronger this year. Yeah, what you see is
Bitcoin is at the
our
open.
best estimate as of today, for how high we need to
Yesterday's
raise rates,
close.
how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today, and as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see. We believe you need to see a better balancing of supply and demand in the labor market, so that you have. It's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is
he's not going to
really
answer that
on
question.
moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve.
I don't know if the market
Steve
wants rate
Matthews
cuts
with
or
Bloomberg.
just
Let me ask you about China.
hard
In the last few weeks,
of
China has
hikes.
abandoned
There's two different
its
things that
COVID policy and
could
been
be going
reopening
on
pretty
there.
strongly. I'm wondering if you see that as
One thing about it.
disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening.
They've
backed away from their COVID
low.
restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path.
Like a 5
so
or a
the way we think
4
about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael, Kate.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not,
or what?
and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So, if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there. And
ultimately, I don't know if we get a very big bullish pop off of that, but he's very optimistic.
Of course, we
they
welcome
have
these
seen evidence that
better inflation
is
reports for the
indeed
last 2
coming
months.
down.
They're very welcome.
The
but
market
I think we're
is
realistic
pushing
about the
higher
broader project.
off of support.
So that's all. That's
Bitcoin's
the point I
not
would
really
make. It's,
doing anything. Though.
We see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome. But we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6%,
or just
CPI.
under it,
That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go.
Current trade that I am in is up 12%.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this.
The soft landing has already happened,
to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible.
Yesterday's
I don't think anyone knows
this white line.
Whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Yeah, dollar's top. Risk markets probably bottomed.
Hi, Chairman Powell. Brian Chung, NBC News.
Everybody
you warned
waiting for a
Americans
blow
of
off
pain
on the
earlier
VIX
this
is
year
gonna
as the
be
Fed
late.
hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
15% on the grade right now.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will.
Yeah,
we're certainly highly committed to do that.
For, I don't know now, few months, since June.
Mr. Chair, Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Right there.
Nicole.
This is where we are. This is where they want it to be.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest.
That's
in
what
recorded
happened
history.
right there.
All of that because of a tight labor market. A tight labor market which had
He's not
inflation running,
expecting that.
just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the monitoring?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on
You
that.
just took out the low on the VIX. Yesterday's low. Bitcoin pushing up to our $18,000
Nancy
target.
Marshall Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals.
31% on the trade right now with this green
it's hard to
candle.
deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Wages, nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now,
We're pretty much over where you would be expecting a retrace and expansion much lower. So it looks like the market is trying to retrace this move.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You
All right,
spoke a little
Bitcoin's
bit ago. You
pushing
said
up.
that
That's
the
pretty
U.S.
close
it looks
to
like we
the
have
target.
a structural labor
At this point, I'm going
shortage
to take
in the economy.
off
Could you
70%
expand
of
on
the
that?
trade
Talk a little bit more
and
about
move
that.
my stop
And
to break
really,
even.
are you talking
and
about
anything that happens after
getting
this
Congress action on
is just icing on the
increasing
cake.
like legal immigration, things like that?
The trade is currently up
what I meant by that
41%
the structural
in
labor
profit.
shortage is
That is
if you
damn
look
near
at,
half of the account.
where we are now. As I mentioned, if you just look at demand for labor, you can look at vacancies
Stop
plus
is
people who are
at
actually
break
working,
even.
and then you can take supply of labor by are you in the labor market? Are you looking for a job or have a job? And you're
Take
more than 4 million
profits if
people
you are
short.
in profit. Do it.
We don't see.
Do not be
Despite
greedy.
very high wages and an incredibly tight labor market, we don't
We
see
do this
participation
all the
moving up, which
time.
is
We are
contrary
very
to what we thought.
consistent.
So the
All you gotta
upshot
do
of
is
all
hit
that
that
is
subscribe
the
button.
labor market is actually it's 3.5 million people at least smaller than it should have been based on pre-pandemic. Just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million.
Just in
More than it
case
is,
the
and that
sellers
it
come
can.
back.
There are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe. It's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth
The
of just
euro
0.5% next year.
retraced
Given that you've said
the
the
entire
process
move.
of raising rates and getting inflation back under control will be painful,
DXY is
have you
down
had discussions within the committee and addressed how
0.48%
long
on the
and or
day.
how deep of a recession you would be willing to accept?
Told you. And
No,
completely faded
what
that
we do
move.
is we make our forecasts.
Why
and we publish
Bitcoin
them
hasn't,
quarterly.
I don't know.
And, if you look at those forecasts, those are forecasts for slow growth.
It may still
for
later, but
a softening
there's
labor
no
market, by which I
guarantee
mean
that.
unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just, upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as
all right, Nick, have a good one,
having
man.
a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
Now wrap it up. Nice. So now the only thing that's left to do is to just see what ends up happening later. I mean, I'm sure you're going to have a lot of people interpreting that, everything that he said, your Bloombergs, your CNBCs, your Fox Businesses, whatever your favorite talking head TV show is, they'll break it down for you and they'll have experts on if you need them to do so. I don't. The way I do things is I let the market tell me the direction. I will let it finish doing what it's doing today, and then we'll see where it is tomorrow. Currently, like I said, Bitcoin has not nearly done what the dollar has, what the VIX has. The VIX completely took out all of yesterday's low. So everything that happened yesterday has been completely retraced on the VIX. So it's back down to, those lower levels. Big red stuff happening there on the VIX. The S&P 500 did have a down move on the actual news that it got. And so far since the press conference, you faded roughly 0.02%, or at least on the fib. So you can see that you are on the 702 Fibonacci retracement. That is currently where the candle closed. This is typically where people will look for either a downside continuation, or if you start closing candles above that, you get above the high, then there's a good chance that you could see markets continue to trade up for the rest of the day. As far as what we gotten already yesterday with the CPI info, we know that inflation's coming down, and it's coming down good. For the first 4 months, you really didn't do a whole lot as far as inflation was concerned, right? You were only dropping like literally just a couple basis points, right? 9.1 to 8.5 was the biggest drop that we got. That was a very big indicator for me that, there's a pretty good chance this is the top of inflation. And basically, the stance that we've held on this channel is if you consistently make lower CPI prints, then the Fed will be able to say something to the tune of what we are doing is working because inflation is coming down. There's a whole lot of other data points that they're looking at, other things that have them concerned. The jobs, for instance, has them concerned because they, maybe it happens later, but eventually they are looking for a spike in job unemployment. So, it hasn't really started to happen yet. So that's going to keep them being hawkish, but they will be hawkish until they get, some significant drops on the CPI. All your inflation prints, they want to see inflation lower. This is the one that they have, the inflation rate year over year. This is the one that they have a 2% target, 2.0% target. So until this number is 2, they will not be happy. But, you know, they won't be as hawkish if we start seeing significant drops. Last month, you went, well, for these 3 months, you just had 0.2% drop each month. That's not what the market liked to see. That's why the market's been just chopping around, being sideways. Then the last 2 months, boom, boom. Those are nice steps down. So all in all, was this an uber bearish day? No, not to me. I mean, it hasn't affected my bias, but technically I let price guide my hand, right? We did break back under this trend line. So if the markets do decide that they want to have a significant pullback or a pullback of any kind, we will be all over it. We will look to sell resistance. Will we nail the absolute top? No, we will not. But will we get positioned enough to catch any downside movement that we get? Yes, we will. Currently, we have been long. We have shorted the dollar. We have a dollar short position right now running open on the USD JPY. And this trade was very much caught almost on a top tick. We have seen no data from the markets or from anything else that suggests we should close this position. Okay? Nothing. Nothing at all. This position looks fantastic. Entry. This is where we are currently. So just on this short dollar USD JPY trade, we are currently in profit 1,675 pips on like super uber bullish things that were happening, right? Technically, there was a specific reason why we shorted on this day at that time. We were taking a short position on the DXY. We got into that position. We have also purchased Bitcoin longs. And our long entry on Bitcoin, this is a fantastic looking week. A weekly, if it closes here or anywhere up around here, will look great. This was our original long entry on Bitcoin. We waited for this weekly candle to liquidate this weekly low. That was where we took our long position. So we got long there on Bitcoin just a little bit after we took the short dollar position. So we are currently long and strong risk. And we haven't seen any reason to close any of those positions. None. If Bitcoin is to find resistance. Now, look where you're currently trading as far as liquidations go on Bitcoin. If you were going to see a downside market. So we nailed this with this same exact strategy, the same exact thing that I'm about to tell you right now. We did not nail the exact top because we didn't get a liquidation on Saturday's high. Otherwise, we would have been sitting right there with short positions waiting on this move there. We didn't expect anything like that. We just knew that we had liquidated everything in the range since the last CPI. This CPI candle. Boom. That dump. So this was the high right there. Once we liquidated that, and then this, and then fell back under. So on this candle, you didn't fall back under the liquidation zone. You stayed well above it, closed above it. This candle started out with a down move per beginning of the week. We longed this candle. We took profits on the move up. On this weekly candle, we were looking for shorts. We did it on the day the FTX news broke at a weekly supply zone. Our short entry was right there at $20,692. We capitalized monstrous, like crazy gains on this day. These 2 days, crazy gains. We took profits. We exited that position. We got a better CPI print. Then we switched to long here. Got long. So as long as Bitcoin is trading above this price right there, 17,424, in my opinion, I look for price to move higher. I look for price to move higher. If we close a weekly candle under any significant weekly high, meaning this one right here, then we can look to take short entries targeting weekly low liquidations. All right? But as of right now, there is no reason for us to be looking for short positions. None. If you are looking for a short trade, please step back, take a look at this chart, and answer me why. Why are you taking a short trade expecting massive downside from here? Now, I'm not griping at you guys. I really want you to understand, like, this is probably one of the best buying opportunities you're going to get on Bitcoin, whether it makes new lows or not. Okay? I'm talking about specifically for investing, specifically owning spot Bitcoin. I'm not talking about levered trades. Levered trades where we are literally attacking market swings, day trades, and intra-week trades. We go short and long all the time. But we do have core positions that we are currently holding that are long. We do have a longer term bullish bias on the market right now. We have nailed pretty much most of all of the major turns in the marketplace, and we've been doing it consistently for 2 years because that's how long this channel has been up and running to the public. All right? We have been very consistent in nailing massive turns in the market and getting on some fantastic trends. So what we were looking for on the USD-JPY was a trend reversal, and we have gotten it. You have broken down below all of your major moving averages. You are showing further weakness to the downside. There is no reason to close that short position. Till we start taking out candles to the upside, there's no reason for it. As far as something going on right now, I posted this a little bit today, and the guy, I guess this guy right here, I hope both of these guys are in here because I would love to talk to him, right? Or at least the one that owns this chart right here. Basically, this is what they are looking for, right? They are looking for this. This is a fractal that played out on the 2001.com, whatever, 99.com washout on Amazon. And there is a fractal here that they are expecting on Bitcoin. The one thing that they are failing to understand, or at least look at and analyze, is when Amazon became oversold. Bitcoin is currently oversold. This chart was drawn up before Bitcoin. Well, Bitcoin hit oversold here. I guess it didn't. Right. There it is. Boom. So right here, right there is where Bitcoin is currently, technically, according to the RSI. There is your massive oversold reading right there. Boom. The amount of time it took to get from all-time high to here is it doesn't matter. Right? It doesn't matter. The fact remains the same. You are oversold on Bitcoin and have been for a while. There is bullish divergence there. Here is your Amazon chart. When you hit oversold, there is no bullish divergence there. And that's all I was stating. That the chart on Amazon, the fractal on Amazon, is not even close to what we're seeing happen on Bitcoin right now. But if you look here, when you are oversold, this low right there, which is divergent, is a higher low than that low. This low marked the bottom of the market. Right here is your price chart. So this is where the wave 3, 4, 5 is. I'm just making my point known. If he wants to do a live stream or whatever with me, I will absolutely do it. I have no problems with it. And he can explain to me if he wants to. He doesn't have to either, right? It doesn't matter. But what I'm just trying to say is this is when you were there. So, anywhere in this green area, that's when you're oversold on Amazon. You made one last push lower, and that marked your bear market low. That's it. So literally, if you're even looking for any more downside on Bitcoin based off this fractal, you should only be looking for one more swing low. as a matter, because you're here. You're right here on Bitcoin. You're at the 3. Now, I was told that this is not a wave count. This is a bubble busting, bottom breaking, buttoning formation pattern. I don't even know what it is, right? I don't understand what that means. I'm not privy to it. But, you know, this guy right here, this is his chart. Bubble pop pattern or whatever. Yeah, I mean, bubble pop pattern, got it. But that's where you are currently on the RSI on Bitcoin. So you're the most oversold you've ever been on Bitcoin. You know what I'm saying? Is it possible that it makes another low? Absolutely. I'm not saying that the low is in. I'm just saying, looking for any massive breakdowns from here, then that means you're expecting like an '08 type of bearish market sell-off. And the fact that inflation is already topped out, I don't believe you're going to see that. A massive '08 style sell-off. Can you still get bear market lows? Yeah, you can, but guess what? I'll be a buyer down there too, right? I'll be a buyer down there too. We know that Bitcoin is massively oversold. We know that it is inside of an undervalued area. This is where people need to start looking for opportunities. If you want to finally get on the right side of the market, you should do so. You know what I mean? By listening to people that have a track record of being right. All right. The day trade that we just took today, my position was just stopped out. So hopefully you heeded my advice when I told you to take profits just under $18,000, because there is a chance that the sellers come back there. You can see that they did. So we will pay attention to this. This is old daily res. This is yesterday's close. If Bitcoin is unable to close hourly candles or even maybe 4 hourly candles underneath 17,773 tomorrow and moving on, we will be potentially looking to position ourselves for long opportunities once again. All right. For long opportunities again, because when your asset is trending up, even though long term it's obviously a downtrend, you are in a wedge formation. It is a downtrend on the longer term scale. But for the near term, you do have a trend and it is moving to the upside. You are currently above your 21 exponential moving average on the daily time frame. So basically near term, this is very near term analysis. You have potentially made a bottom. All right. Oil's getting crushed. It should be getting bought. It's not. It's getting crushed. You just made fresh yearly lows on oil, and you were bearish on the year for a brief second the other day. I put out a tweet the other day that said that if people are done getting liquidated here, then we will potentially be looking for bullish entries on oil for 2023. Because I do believe that the China reopening, and if inflation starts to go lower, higher oil helps inflation anyways, right? It just does. Higher oil is good for inflation, but I do believe that oil could catch a bid for 2023 just by China reopening. You're going to see a surge of influx for demand. This thing is heavily manipulated because OPEC can absolutely control whether there's more supply in the market or less, right? So they can pretty much make this thing do whatever they want. But everybody's concerned about seeing an '08 type of bear market crash. Well, if that were the case, you would want to be seeing oil make just massive moves to the upside. The market has spoken. The DXY is where the money went, not the VIX. If you are looking for a massive blow off top on the VIX, like what you got back in 2020, if this is what you're looking for before you decide to ever become a buyer in the risk market again, I honestly believe that you will be late. You will be very, very late. I do not believe you are going to see a blow off top on the VIX, because the dollar is where the money went, not the VIX. All right. So if the money went into the dollar, then what you should have been paying attention to is a blow off top on the dollar. And you have kind of sort of gotten that. So is it possible that the dollar goes up and makes highs, new highs? Yes, anything is possible. I cannot see into the future. Therefore, I do not know what the price will be anytime in the future. Not 1 second from now, not 1 year from now. I don't know. But I just let price be the guide of my trading decisions, and we do all right here. Thank you guys for being here very much. I really appreciate everybody that's been here. The next live stream that we'll do for the public will be Tuesday morning. We typically start those anywhere from 8 a.m. to 9 a.m., and we try to catch the New York stock market open. We do take trades live every time, or at least we try to take trades live every time we're awake or on the live stream. So if you guys want to be, if you want to be here while we do that, and we are very consistent in making money on this channel. So make sure you guys hit the subscribe button. Go ahead and throw me a like if you don't mind, as obviously that helps people find the channel. And all that good stuff. We'll see you guys Tuesday. Wait, what is today? Thursday. No, today's Wednesday. Never mind. I take all that back. We will be live tomorrow. Tomorrow morning at 8 to 9 o'clock in the morning. Tomorrow's Thursday. Tuesdays and Thursdays is when we go live on the main channel. Right here where you are right now. So if you want to catch us live in the morning for the New York Open, then just go ahead and hit the subscribe button. We'll see you guys tomorrow morning. Thank you so much for being here. As always, make sure you guys trade safe. Make sure you trade smart. And happy trading, everybody.